Welcome back to Alpha Recap. I'm glad you're with us. We've got a packed episode covering rotation, earnings, and a few concentrated catalysts that moved markets today. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. Great to be here to unpack what was a pretty eventful day across sectors.
Quick framing to start. Markets closed with rotation and mixed leadership after a day of macro crosscurrents and idiosyncratic moves. Three things jumped out. Renewed attention to value, Goldman Sachs saying second quarter earnings are the big test, and cluster moves tied to oil and AI validation. So, Kate, take us through the headline.
Sure. In short, investors were repositioning. Value popped back onto the radar because of inflation dynamics. Earnings season looms as the proximate arbiter of whether the rally is sustainable. And then you had concentrated drivers, like cloud AI validation for GPUs and an oil bump helping energy, that created winners and losers.
So, what really stands out here is how all three threads tie together into who leads next.
Exactly. Positioning is active. Leadership is contestable. And whether the market broadens or narrows will depend on upcoming data and corporate reports.
Let's dig into the value versus growth debate first. Give us the mechanics. Why would value lead when inflation is elevated?
It's a pretty standard linkage. When inflation runs hotter, nominal discount rates tend to rise, and the term structure steepens. That makes long-duration cash flows, which you see in many growth names, less valuable in today's dollars. Value stocks, which tend to have nearer-term cash flows, are less sensitive to that shift. So you get a relative boost for value.
And I remember one note saying, a single metric explains much of that relative performance gap.
Right. Analysts highlighted that one metric can capture the performance differential in high inflation regimes. And that's why some newsletters are redeploying into a focused roster of value names.
But growth hasn't been asleep this year. Tell us about that.
Growth actually bounced back and is up about 9% year to date. So the story isn't one-sided. Growth rallied, largely on earnings momentum and technology strength. That's the practical disagreement. Is value going to reassert because of inflation? Or can growth sustain its recent gains?
I mean, when you step back and look at this, that 9% move is a big deal for growth.
Absolutely. If earnings continue to come through for growth names, that supports more durable outperformance. But if Q2 disappoints, the story can flip quickly.
Let's pivot to that. Goldman Sachs called second quarter earnings the critical test. Walk us through why that matters right now.
Goldman framed it this way. Recent gains look like they're driven more by earnings growth than by multiple expansion, which is encouraging. But mid-July's earnings are the proximate test. If companies broadly beat and provide confident guidance, the earnings-driven narrative strengthens. If they don't, we could see multiple compression and a quick repricing.
So it sounds like the difference between a sustainable rally and a breathless market depends on actual corporate results.
Yes, analysts note that conviction will hinge on actual EPS growth versus expectations, plus the tone of guidance. That's why this window is so signal-rich.
Right. And the other thing is, consumer sentiment and inflation worries kept surfacing in the research today. Morgan Stanley had some interesting survey work on that.
They did. Even as headline inflation eases, consumers still rank inflation as their top perceived risk. That's behavioral. It shapes spending, margins for retailers and discretionary names, and keeps defensive, cash flow-rich sectors relevant.
Which connects back to value again. Defensive names with steady cash flows look attractive when consumers are anxious.
Exactly. And that's why you're seeing some insurance and life names outperform, investors leaning into stability.
Let's talk about the concentrated, event-driven moves now. NVIDIA confirmation in Azure was a big one. Explain why that mattered.
NVIDIA's hardware being validated for Anthropic models on Microsoft Azure is a real operational confirmation. It supports cloud GPU demand, strengthens the enterprise adoption narrative, and gives investors more confidence that cloud AI deployments will sustain CapEx and GPU cycles.
And at the same time, oil headlines sparked energy strength, right?
Yes, a late February strike that tightened supply helped push crude higher earlier in the year, and that reweighted returns in Q1 for companies like Chevron. Merely a single supply shock can change positioning and performance in funds that are exposed to energy.
Honesty check. I was a bit surprised by how concentrated some of these moves were.
Yeah, concentrated is the right word. You get a handful of names capturing most of the headlines and returns, which can make the broader market feel fragile if those names wobble.
Quick reaction? Right.
Yeah, that tracks.
Now, some specific data points listeners might find useful. Several insurance and life companies had notable runs, and a couple of mid-cap names moved a lot. Can you read off the numbers conversationally?
Sure. Selective Insurance was trading around $96.40 after a 6-month run that outpaced the S&P by about 7.3%. Globe Life was about $178.90, up roughly 26% over 6 months. Jacobs Solutions was about $125.68, down roughly 7%. Media Alpha traded near $12.19 after a mixed quarter. Nike was sitting at a 12-year low, with options pricing about a 20% implied move into earnings. And Chevron and other energy names showed that commodity-driven bounce.
Nike's setup caught my eye. A 20% implied move is massive.
It is. When options imply that kind of move, short-term directional traders and volatility sellers face real tail risk. Even long-term holders need to be prepared for sharp, earnings-driven dislocations.
There were also some quirky metric callouts in a Meridian letter. Numbers like roughly 125%, about 50%, and roughly 1%. What's that about?
Those were valuation or performance callouts in the investor note context. They're meant to illustrate outsized moves or specific metric spreads, not to be taken as standalone signals. But they do underscore how numeric illustrations in fund letters can highlight concentrated wins.
Okay, let's move to what this means for different investor types over the coming weeks.
For long-term, fundamentals-focused investors, the second quarter earnings cycle is the main signal. Analysts are watching margin commentary and backlog statements in cyclicals and tech. Value allocators still have a case if inflation persists, but selection matters. Look for companies with resilient near-term cash flows. Growth and AI investors got a positive hardware validation today, but they should watch earnings and rate sensitivity. Income and defensive investors are finding some confirmations in insurance and life name performance. And traders should be mindful of event risk. Big implied moves, like Nike's, mean elevated short-term volatility.
Got it. So monitoring Q2 results, inflation prints, commodity headlines, and options implied moves. That's the shortlist?
Yes. Track earnings beats and guidance cadence around mid-July. Watch consumer sentiment and inflation prints. Keep an eye on commodity shocks, and use options implied moves as a gauge of market nervousness.
A quick trader check. Volatility. Sellers should be extra cautious into earnings and big retail reports.
Definitely. Elevated implied moves mean tail risk. Traders selling premium in these names can be caught off guard if the actual move exceeds expectations.
And for longer-term folks, earnings consistency matters more than yesterday's headlines.
Right. Analysts note that if the rally is fundamentally backed by earnings, leadership is more persistent. If it's mostly sentiment and positioning, it can unwind quickly on disappointing results.
Let's wrap with 3 clear takeaways for listeners.
First, treat the coming second quarter earnings window as the key test. Mid-July is the focal point. Second, Inflation and consumer anxiety keep the case for selective value and defensive cash flow names, but growth can still lead if earnings hold. Third, expect episodic, concentrated moves from commodity shocks and tech validations. They can reallocate short-term returns sharply.
Perfect. Quick closing reaction. Wow, that's a lot to keep an eye on.
Yeah, it's a busy stretch, but a lot of information to use for reassessing exposure and risk budgets.
Okay, that's our recap for today. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. We'll be back after earnings season with another recap.